All right, let's dive right into this explainer and unlock the secret language of market charts. Today, we're focusing squarely on the logic behind institutional buying. We're going to track the massive, totally invisible footprints left behind by central banks and institutional whales. If you've ever wondered how the absolute biggest players out there manage to move billions of dollars without the rest of the world noticing until it's way too late, well, you're absolutely in the right place.
So, to track this smart money, we're going to cover four key areas today. First, behind institutional buying. Second, spotting the order blocks. Third, the rules of the trade. And finally, we'll wrap up with your step by step strategy. The ultimate goal here is to align your own moves with the biggest financial players in the world.
Section 1, Behind Institutional Buying. We're going to kick things off by looking at the sheer scale of central bank trading and really dig into the logic of why they operate the way they do. Which brings us to a pretty fascinating problem, right? How exactly do central banks and massive financial institutions buy millions, actually scratch that, billions, of an asset without totally crashing the market or sending prices straight to the moon? The logic of institutional buying is totally dictated by their sheer size. These massive entities have to carefully split up their orders to avoid making huge waves. Think about it. If they just hit buy on their entire portfolio all at once, they'd trigger extreme volatility, and honestly, they would completely ruin their own entry price. To put that into perspective, imagine a massive bank needs to buy 200 million of the euro to US dollar currency pair. They literally cannot do this in one go. No way. If they tried, the price would skyrocket instantly, meaning they'd pay a massive premium for the back half of that order. So what's their logical solution? They break that 200 million down into 3, 4, or maybe dozens of smaller steps, quietly making their purchases over time at a very specific targeted price level. And it gets even more secretive than just chopping up orders. They use highly sophisticated tactics to completely cover their tracks. For example, they might broadcast a typical trade size, say just one standard lot, on the bid or sell side to the rest of the market. But behind the scenes, they're actually hiding a massive block of 1,000 lots. It's an illusion. They do this to stay invisible, keeping volatility super low while they quietly get their business done. So here's the absolutely crucial takeaway. These hidden zones, these massive footprints left in the sand by market whales as they quietly go about their buying and selling, they're called order blocks. An order block forms right where these big players find a comfortable supply or demand zone to execute those massive split-up orders. And if you know what to look for, these blocks act as a literal treasure map for the flow of smart money. Moving right along to Section 2, Spotting the Order Blocks. Now that we understand the logic, how do we actually spot these things in the wild? Well, if you're trading using standard level 1 market data, meaning you're relying mostly on price charts rather than raw institutional order flow, you're going to see these blocks manifest in two distinct phases. First up is the bullish order block. This is an accumulation phase where institutions are quietly gathering an asset. And the second is the bearish order block, which is the distribution phase, where they are slowly, methodically selling it off. Take a real-world bullish order block scenario like the US dollar to Japanese yen 4-hour chart. Let's say the Bank of Japan wants to artificially weaken the yen to stimulate economic growth. To pull that off, they have to buy up massive amounts of US dollars. What they do is lock the price into a tight sideways trading range. That right there is the accumulation phase. They keep it in that narrow band so they can quietly buy. And when you spot unusual green volume spikes at the bottom of that range, bingo, that's the footprint. Once they are done accumulating, the price breaks resistance and the bullish trend violently takes off. On the flip side, we have the bearish order block, like what happens with the US dollar to Swiss franc. This is the distribution phase. Picture a central bank holding the price up in an upper trading channel, just slowly distributing their assets to unsuspecting retail traders. Once their massive sell-off is complete, that support level completely shatters, and the price plunges right in the direction of the big player's intention. All right, Section 3, Rules of the Trade. Before you jump headfirst into the markets, we need to lay down the strict logic required to actually trade alongside these giants safely. You've got to keep 3 foundational rules in mind here. First off, order blocks do not happen every day. Central banks certainly don't announce their entries, so this is a pretty rare occurrence. You can't force this strategy. You literally have to be patient and wait for it. Second, the longer the range, the bigger the move. This is straight out of Wyckoff theory. A longer sidewise range means they are building up massive liquidity, which leads to a much more explosive breakout. And third, always confirm unusual activity with volume indicators. Things like on-balance volume or a volume-weighted moving average. You absolutely need that volume spike to confirm a big player is actually in the room.
Which brings us to Section 4, your step-by-step strategy. Let's get you equipped with the exact sequence you need to capitalize on these institutional movements.
You'll want to follow this sequence rigorously to align with their institutional logic. Step 1. Identify a sidewise ranging market with unusually high trading volume. Step 2. Figure out if it looks like an accumulation or a distribution phase. Step 3. Don't just guess. Confirm the signal with other technical analysis tools like moving averages or Fibonacci levels. Step 4. Enter your trade only when the price actually breaks above or below that support or resistance level. Step 5. Protect your capital. Always place a stop-loss order just outside that breakout level. And finally, Step 6, monitor your trade and plan your exit when you see another massive spike in trading volume, because that signals the next institutional move.
Now, I want to give you an advanced pro tip if you really want to take this to the next level. Order blocks, they have a memory. You can actually mark these historic blocks on your chart and just leave them there. Because these levels represent such massive institutional interest, they often act as incredibly strong supply and demand zones well into the future. The price will frequently return to a historic bullish order block and just bounce right back up. Smart retail traders take advantage of this by setting pending buy or sell orders at these proven historic levels. Spotting these footprints literally comes down to understanding the core logic behind the market's biggest players. It's the difference between riding the wave of massive institutional momentum or getting completely crushed by it because you were on the wrong side of their hidden trades. So, as you analyze your charts today, I want to leave you with one vital question to think about. Are you trading with the institutions, or are you just providing their liquidity?